we got off to a bad start, only because I let my emotions come into play, and I pulled out of the market too soon. I had two this morning. I had two calls, 465 calls, and actually, if I would have stayed in the game, um, I would have made some type of profit instead of being at a loss for today. But I got out too early because of I was worried about the theta eating up the value of the contract. So that's a mistake that was made this morning. Was getting out a little bit too soon. I could have waited maybe another hour or something like that, and at least would have done way better. Let me see what that's at. Matter of fact, I sold two 465 calls for about $96. Now, they're about 340. So I wouldn't be at a loss for today. I actually bet at a small gain for today. But anyways, we're back in the game, and right now I'm buying contracts that are about to expire today. I have a contract. I have a 468 call, and I have a 463 put that expires. Well, that expires today. So we're gonna see how it goes. Um, we're gonna see if we can catch. And I'm buying a call and a put. You know, just believing for a $2 movement before the end of the day. If the market moves $2, so basically altogether I have about $70 invested. If the market moves $2 on the call, that would turn that would bring about, I'll make about $95 on the call. If the market moves $2 on the put, I'll make about 170. And I got about $70 invested. So I'm hoping that it will move on the put, but I got the call in there just as a safety precaution. Um, in case it goes the other way, I can at least recoup some of the gains. The main thing with this strategy is that you don't lose money because the market goes in the wrong direction, but mainly you lose money when the market does not when the market is quiet, when it's not volatile. But just a $2 movement, and so I got $70 right now. I have about $70 invested in the game, and just a $2 movement with $2 movement would bring us to 170. So that's over 100. That's like a 120 profit because I paid $50 for the call. If it moves $2, then that's 170. And so 170 minus, so I would make 170 on the call minus the $20 that I made on the put. I would still make about 150. I still make about 150. Spend $70 to make 150. That's pretty good. For an end of the day play, considering the account size. But on the other hand, if it moves $2 up, we still make about $95. We make $95 on the call, we lose $50 on the put, and so we walk away with about $40 profit. So, either way it goes, we can make some type of profit if it's volatile. I just put that in for right now because I do see a pattern that I'm about to show you guys in just a couple moments. And I'm actually looking for the right time to buy more contracts because obviously, you know, um, that's not a lot of money at all, and that's just the beginning play. I look at the market like chess. You make your move, then the market makes it move, and then you make your move. But you can't throw your queen out there too soon because uh, The queen is the most valuable piece that protects the king, and so when you're playing chess, you throw the pawns out there first. And so right now I just threw the pawns out. We got $50 on the call. We got $50 on the put. You know, but what I am looking to do. I am looking at this December 23rd call, which is tomorrow. I don't believe the market is open on Christmas Eve because it's only showing me December the 23rd on the options. Let me go ahead and move this for you guys to see it. It's only showing me December the 23rd on the options. So, and then it says December the 27th. So I don't think the market is open on, you know, Christmas Eve. But anyways, you know, we're gonna see what happens. Let me go ahead and get you guys. Let me show you the chart of why I decided to begin to engage right back in the market. You know, if I can just take it back this morning, all I would have done is I would have went back to the chart and timed my exit strategy, because I have the tendency to get in the market through timing, you know, and preparation, but I don't prepare to get out. I just move by emotion. That's what kind of got me. So I mean, if you got to prepare to get in, you got to prepare to get out, you know, and that's just a learning lesson. But anyways, let's go ahead and look at some charts here. You know, I want you guys to see what I'm looking at. It's a short play. It's on a 1 minute chart, you know, so it's something that can, you know, something that can happen, you know, at any time now. You know, I'm gonna actually, let me see if I can just draw it on the board. Okay. All right. It's actually going up now. But anyways, let me show you guys the board real quick. Okay, this is the board, right? And so this is, whenever I see this, you know, I like to I showed you yesterday that these what I'm about to circle is like, you know, they're like twins. You know, this, whenever I see that pattern, it gives me an indication that something is about to happen. You know, sometimes what you will see when you see that pattern is you'll see the market drop again, and then it'll come right back up, and it'll kind of, you know, it'll kind of settle around this range. And if it can't break through this range, then what would happen is it would fall to a newer low. And so that's what I see here on the 1 minute chart. Let me kind of show it for you guys. But so first looking at this, I would think that, you know, that's why I got the put, because I'm like, okay, the put is gonna you know, the put is going to you know, the put is gonna print. Let me put it on the screen real quick. That's exactly what I'm trying to show you guys, what I just drew on the board, that right there. But then the market drops, as I said, and it does go back up, but it breaks through the range. You know, it breaks through the range. And it breaks through the range and comes back down. Now pay attention to this third part, this other box that I'm using a pin to kind of circle around. Now this is the 1 minute chart. Let's see what it looks like on a 3 minute chart, because it can look like it's about to drop, but then turn around and be bullish. And that's what's going on right here. Is that it broke through the range that it normally would have if it's going to drop. It broke through the range, and instead of being a M, it turned around and became a W. Let me show you something so I can kind of make these patterns a little bit clearer. Remember what I told you, if the market goes up, it goes up in the shape of an M, right? This is kind of like an M, if you guys can see it. It's an M. It comes down right here, comes down right here. And so that is, you know, looking at this first glance, it looks like it's an M. And that's what I said, you know, if it comes back up, you know, I said if it comes back up and it doesn't break through that range, you're going to see that M take it to a new low, right? And inside of the M, you see these two pattern designs right here. Okay? So, first glance, you would think the market is going to just drop. This is the 1 minute chart we're looking at. But it doesn't drop, you know, and it actually does the opposite, and it gets past the range. It gets past the range, and it begins to form a W. And we're looking at the 1 minute chart. You know, we're live, we're trading right now. It begins to form a W. And what you see here, let me show you. So this is kind of like the W. Now, when I say the market goes up in a W and it comes down as an M, you know, it's not a perfect W, but you can kind of see that figure. You can kind of see that figure in the market. And so that's what happened right here, is that the M was formed, but it didn't drop to a new, it actually broke through the range, and then it kind of settled, and it made another one of these marks right here. It broke. So what happened was that it broke through the range. It made another one of these patterns right here, and then it went up to a new high. And so, you know, right now what we have is we got a market that's just ranging. You know, it hasn't gone to a new high and it hasn't gone to a new low, but it's just ranging. So that's why I just got the two contracts so far, because I got one contract for if the market, you know, decides to, because I mean, even the W that it made, you know, it's not like it's a strong candlestick and that it just went to a new high. It made a little W, but it's still ranging, you know, so it can still turn around and you know, it can still turn around and retrace. And so right now, my bet, or however you want to call it, what I'm looking for it to do, I'm looking for just a $2 movement before the end of the day. But the thing about it is that if you're aware of the options market, is that the contracts expire. So right now it's about 103. I'm probably going to give it another 30 minutes and purchase some contracts that's going to expire tomorrow, you know, if I don't get any movement, because, you know, I saw that M on the 1 minute chart, and I was assuming that, okay, with the M on with that pattern on the 1 minute chart, the movement should be able to happen, within an hour. Like this morning, for example, when the market went up, it formed a W with the same pattern, and and let me show you what the W was formed. The pattern was formed by, let me see what time. The W was complete by about 10:06 today, or 10:07, and then from 10:07 to 11:14, which is about an hour, the market went up $3. It went up $3. So that's why I'm like, with the 1 minute chart, if I can see a W on the 1 minute chart, I give it about an hour to see what it's going to do. In this case here, I saw the M, but then again, the range was broken through and it formed a W. And so now the W is, we're trying to see what that's going to do. But another thing I want you guys to pay attention to, I showed you the W's, I showed you the M's, but you also got to be able to respect that whenever there's a pattern, for example, let's say the market forms a W and it goes up. If the market forms a W and goes up, right? How high? How do you know how high it's going to go? Where should you set your take profit at? Where should you set your take profit and your stop loss? I'm gonna show you. I'm gonna tell you where you should set it at. There's gonna be on a bigger chart. Like let's say you see the W forming on the 1 minute chart. Okay, and so it's gonna go up, and then so you buy the contract because you're thinking it's gonna go up, and it does go up. But how do you know when to set your take profit at? You're gonna go through the different charts. You're gonna go through the bigger time frame charts, and you're gonna look for this pattern right here. And when the market hits this pattern right here, whether it's on a 1 hour chart, 2 hour chart, 4 hour chart, you expect the retracement. That's how I calculate when I'm gonna get in and when I'm gonna get out. For example, this morning, the market formed that W, and it was bullish, or it continued to go up all the way until it came to this mark on the 1 hour chart. The mark that I just circled on the screen, you can see that right here with the red, the green in the middle, and the red. And that was that's on the 1 hour chart. So that means that was 466. So it was at 463 when it formed the W, and the next mark was at 466, and that's the resistance. And when it hit that resistance, it has to take a break. It can't go past that. And so when I see that it hits a resistance, like let's say I don't chase trades, I like to get in the beginning, and I would just wait for it to go to the next resistance. And so at the next resistance, what happens is the market is either going to pull back or it's going to reverse. That's what happens at a resistance. It can pull back and it can reverse. And that's what we're looking at right now. The market is at a resistance, at 466, because you see that mark on the screen. It's the same mark that's on the 1 minute chart. So it hits that resistance, and now it's kind of just ranging, and we're trying to see where it's going to go next. Now, why did I get the contract? Why did I get the put contract for 463? The reason I got the put contract for 463 is because I'm looking at, let me tell you the chart that I use to determine where I'm going to get that contract. I'm looking at the 15-minute chart. If you go to the 15-minute chart, you see that mark again right there. So if the market was to pull back, I believe it'll pull back at least to the next mark, which is 463. And that's where I got that contract. And that's where I got that ideology that, you can if this put contract is successful, it'll turn about $50 into $170. because I'm just calculating the different prices between 463 and 466. I'm just calculating what $3 would be, because $3 is what I see on the patterns, if that makes sense. So on the other hand, let's say it doesn't pull back. It forms a W and it goes to a new high. Where am I looking for the next resistance to be? Let me see. I don't see any resistance. You see all that red right there? All this red right here? I don't see no resistance on the 1 hour chart. So I got to go to smaller chart frames. Okay. So it's ranging at the 466 mark. But if you see right here, 468 is where there's another resistance at. So if it does break through and continue to go up, I'm hoping for it to go up to at least 468, because that's where the next resistance will be. At the end of the day, the market goes up or it goes down. There's no question about that. The whole thing about it is it going to go to the next resistance or the next support before the contract expires? That's where the risk is about it. It's going to always go to the next high, the next low. It's always going to move. But is it going to move before your contract expires? That's where the skill really is. I'm not so much trying to predict that it's going to go down. If I have a feeling, a good feeling that it's going to, because at any given time, the market can go either way, can go up or down. If I feel stronger that it's going to go up, then I would probably buy 2 contracts going up and 1 contract going down. If I feel really strong that it's going to go up and it really doesn't even look like it's going to go down, I will buy more contracts going up, but to protect my downside. So there's 2 patterns that I can see in the market at any given time. I can see a W shape and I can see an M shape. In any chart, and you can catch, I'm telling you, you can catch 2 patterns in every chart. And why is that? Why is there a W always forming and an M forming at the same time? Because you might be able to see that the market is going to go up for the rest of this week, but on the month chart overall, this is going to be a down month. It's going to go up this week, but then next week it's going to drop and it's going to go it's going to be an M. So it's going to be a W for this week and it's going to be an M for the month. So there's patterns inside of other patterns. You can have W's inside of M's, M's inside of W's. So I always try to calculate when I'm placing a trade, where's the next W at and where's the next M at. I'm not really trying to predict if it's going to be a W or if it's going to be an M. I'm past that stage. I'm just trying to identify the W and the M and then buy contracts on both of those patterns. And all I have to hope for after that is that my timing is good enough that there's volatility to bring it to the next support or the next resistance. So that's pretty much the game right there. In a volatile market, where the theta is not eating up all your it's not eating up all your option, you're going to be able to prosper, you're going to be able to make money. But the market has to be volatile. Like right now, the market is still ranging, from 466 to 465, and that's been since 1045. It's still in that range. I just need a breakout, to happen before. I really need a breakout. I'm really gonna let's do this. Let's go to the option chart. I'm looking at the option chart. That's December the 23rd. Let's go to the 22nd, right? Remember I told you I bought the 468 for $20. That's still at $20. I bought the 466 for $50, and now it's at $43. So now I'm down about $7 because the market is still ranging, and these options gonna expire, before the close of the day. But I'm not so. It's not the end of the game, because at the same time, while these options are expiring, the options for tomorrow are getting cheaper. So I got my eyes on the 468 for tomorrow, which is about $92, and the 463, which is about $63. You know, so if the market, if those other options expire, it's okay because I'm gonna get into the other options that's going to expire tomorrow. You know, that's why I didn't put all my, chips at the same time, because I wanted to be able to maneuver. I wanted to be able to maneuver around a little bit and not just be tied up in one trade. So I'm just trying to show you guys how to be able to trade the market, on a limited budget, and still trade as if, you're in a hedge fund or something, because the name of the game is just to stay in the game. If you can stay in the game, you're gonna win. You hang around the barbershop long enough, you're gonna get a haircut. That's what the saying is. So that's what we're doing right now. We're watching the prices. We're watching the prices, and we're watching the patterns. We're watching the patterns to determine the direction of the market, and we're watching the prices so we can monitor what the profit will be. Right now the market is just ranging. I just need for it to, this is the 5-minute chart right here. I just need for it to go to this next support, which is 464. That's $2. And I just need that to happen. This is the 5-minute chart. I just need that to happen before the end of the day. And if it happens before the end of the day, like I said, you'll turn $50 into 170. If it doesn't happen before the end of the day, we're going to go ahead and get some put contracts for tomorrow, and we're going to we're going to just continue tomorrow on the same pattern, because the whole thing is about being resilient. Now, on the other hand, if it does decide to form a W and go up to a new high, I just want it to happen before the end of the day. Regardless of what the market does, it doesn't matter if it goes up or down. As long as it's volatile, we can make a profit. What kills options when you're trading options is that the contracts are due to expiration. And a lot of people say that, maybe the hedge funds, they're the ones in control of making sure contracts get expired before it reaches their target, their price target. And so what we have to learn to do when trading options is we got to learn to maneuver. Like I said, I got these contracts that are going to expire today, but I'm also eyeing the contracts for tomorrow. I'm also eyeing that for tomorrow because, okay, if it doesn't happen today, within the hour, okay, I'm pretty sure the contracts that expire tomorrow, I can get it at a cheaper price. I'm already looking at I was already looking at the 468, and right now that 468 is $92, and I was looking at the 463 on the put, which is about, it was $64, but now, yes, it's 63. It's still the same price. So the contracts for tomorrow that expired tomorrow, they're basically the same price. But worst case scenario, if these contracts that I have today, I got a call and I got a put, if that expires, then I'm expecting the contracts tomorrow to at least be cheaper, so that way I can make up the money that I lost today. And then we just keep doing that same exact thing. There's no way that you can be that resilient in the market and don't get a big hit. I've had a couple big hits for $10 drops, on put options in the market, and that just comes from being resilient. So the name of the game is to just stay in it long enough, and you're gonna get a haircut. But if you can't take pain and you can't take losses, it's gonna be hard for you to be successful in this game. You got to be able to stay in the game. You got to be able to, get right back in. Like this morning, I was in some contracts overnight, and what happened this morning was I thought the market was gonna move overnight, and it didn't move overnight. I had 2 contracts that I bought for around $100-something, and they ended up being worth like $96 or whatever, and I just got out of them too quick. If I would have stayed in just a little longer, then I would have made about a couple $100 more. So I basically I lost. I didn't even I lost on the call options I had. So that's what I'm basically saying is that I learned my lesson for today of what I learned is that it's important to prepare when you're getting in the game, but it's also important. It's also equally important. Your exit strategy is equally important to prepare instead of just like, okay, the market is I'm losing a couple of dollars. Let me hurry up and close out of these positions. For me, I'm learning to do is to control the emotions, to identify where's the pattern at, and prepare your exit stream out. Prepare your strategy to go out. Don't just jump out like that. Prepare your way out, just like you prepared your way in. Because if I done that, I would have saw, there was another W that was actually forming, and if I would have just gave it another hour, then I could have, tripled the amount that I got out of the market. So, that's what happens. So, I'm hoping that this is helpful for you all. We're gonna try to get on again before the day is out, so we can determine or if the market moved $2 or not, and if it did move $2, I'll let you know how that goes. And also another thing I'm looking forward to do, I'm looking to get another contract for tomorrow. I'm looking to get some more contracts for tomorrow, and so we're just going to we're gonna see what happens later on. And I hope to see you on here soon. God bless you and have a great day.